We're going to do the net present value break-even now. It's a lot more involved than the accounting break-even. Accounting break-even didn't have any time value of money or CCA tax shields or any of that stuff, where the NPV one does. So let's go over the question, and then I'll go over the methodology, and then we'll solve it. You have a situation where the company is starting a business selling trucks. They're going to rent a facility for $72,000 per year. The truck, the variable cost and selling price will be $42,000 to sell and $20,000 to produce. And the original investment will be $60,000 in the equipment, which has a salvage value of $5,000, and the life of the project is 4 years. And then the various rates are CCA's 20%. Tax rate's 43.5, and the cost of capital is also 20. So how many trucks do you need to sell to have a break-even NPV? I've just put the CCA formula here for the time being, but let's go over the methodology first. Okay, so there's two methods that the book uses. I'm just going to use the one that I think makes most sense. You'll get the same answer in either one, but here it is. So the first thing you do is you convert everything to annual cash flows. And this is the items that we will be converting would be the net cost of the investment, because obviously you're going to make a investment in a lump sum, but we want it in an annualized amount, so we're going to use an annuity in a second. The CCA tax benefits, which we also want to convert into an annuity, and then any after-tax fixed costs. So once we have converted everything to an annual method, then we use the following formula. So the break-even quantity for NPV will be the annual net investment minus the annual CCA savings. Okay, so if you think about that logically, what it's saying is, and this will be the present value of everything, what are we paying for the asset minus what do we get as a tax break. So that's really what we're going to be paying, plus the annual fixed cost, and this would be after tax. And we divide the whole thing by the price per truck minus the quantity. And in this case, unlike accounting, we multiply by 1 minus the tax rate. We don't need to do that in accounting. There's a variety of reasons. I'm not going to do the formula proof, but just take that as a given. So let's convert everything to an annuity. So to make life easy, what I'm going to do is I'm going to write the PV of the annuity factor for an annuity. And in this case, 1 over 1 plus r to the n over r. In this case, the value of this factor is 1 minus 1 over 1.2 to the power of 4 divided by 0.2. Okay. And that factor works out to 2.5887. And I'm just doing that now because I'm going to use this a few times and I don't want to keep plugging it in. So let's first calculate what's the annual net investment. So the annual net investment, and this will be the cost minus the PV of the salvage. Okay, so whatever you're going to pay for the asset minus what you're going to get back at the end. So the cost was given as $60,000, and the present value of the salvage was $5,000. But if we divide that by 1 plus the discount rate to the power of 4, we get a total value of 60,000 minus 2411. And we get 57,589. But that's not the annual amount. The annual investment is going to be the 57,589 divided by the PV factor for the annuity, which we calculated. Okay. So 57,589 divided by, if I go back up here, 2.5877. Or 5887. And the value that we get in this case is 22,246. Okay, so we're dividing that. So the 57,000 in one lump sum would be the equivalent of 22,246 per year for 4 years, if you look at time value of money. So let's put that number up here. So this is 22,246. And the annual fixed cost, that's pretty straightforward. Let's do that one next. So the annual fixed cost is just, it's given to us. It's 72,000 per year. So we will take 72,000 times 1 minus the tax rate, 0.435. Write that here. And we don't have to take a present value of that one because we already got it. It's going to be the same amount every year. So that works out to 40,680. So the last one we need to calculate is the annual CCA savings. So if we plug in all of the numbers into the CCA rates here, so the cost of the asset for this will be 60,000. CCA rate is 20, tax rate is 0.435. And both of these are 20, discount rate and CCA. Salvage value is given as 5,000. So if I solve for that, I get a present value of the CCA of I get a present value of the CCA of 13,613. Okay, so if I want to convert that to what's the annual amount, I would take 13,613 divided by the PV factor of 2.5887, and that works out to 5,258 per year. So that's the value of the savings. So I can put that in here, 5258. And this stuff is at the bottom is given. Okay, so the price was 42,000. The cost was 20,000. And the tax rate was 43.5. Okay, so if I plugged all of that into the formula, what I'm going to get is a final answer of 4.64 trucks. And as I mentioned last time, you round up. So therefore 5 trucks are needed for a positive NPV. So much more involved in the accounting one. It's more like an NPV, but you just break it down piece by piece.